Hello and welcome to May 20th. Alpha's IAU moves to 42%. Let's go look at that chart. There is a IAU of 42%, and we did get a higher low on the right, as I said yesterday. Remember, this low here was 777. Let's bring up the data box. Look your eye here on the lower low. This low here was 1774. This was 1773, and today we got 1781. This low qualified as a new official dipper low, even by 1 penny. It doesn't matter, it counts. And now we have our stop here at 1770. The low was 1773, and I rounded up to 1770. Why? Because I want to grab as much profit I can off this trade before it concludes. It still has some running time until July, so we'll see what goes on. But the ultimate point is that we are in positive territory. This trade did not have an O. It had a target of 2% of capital. That's our target. We like to get $122 out of this trade. It is running 42% ahead of date of the trade. The trade started on March 15th, and we are now at May 20th, so that's about 2 months. So it's been a long dragged out trade, but it is working in profit, and that's what it has to count, because when this closes, we will end up with this profit on our side of the table, and we get back our buying power so that we can in turn enhance our buying position. We're now at 61.55, which means that we are virtually all cash. Consider 61.55 divided by the total capital today, 66.78, as a percentage, and we are 92.16, or essentially 92.2% all cash. So the market is going what it's doing. Today it had a good major rally. It was expected after several days of dropping. Those rallies happen. That's exactly what it is. The best buying time for the upside is when the market is going down. That's why it's important to keep your trading plan and keep an eye on your buying power and get out. Trade goes against you. It happens. Take that cash, come back into the game. Make a profit, add to your buying power, get right back into the game. So there we are for AIU, and I'm delighted with it. This was trade. I have to remind you that I was not too confident about this trade because it had an implied volatility of 5, which is considered dangerous. And that means that what the implied volatility means that the option price that I paid at 205 is considered to be overpriced. When you hear the word implied volatility, a high implied volatility, that's today's lesson. That means that the option that you're buying is in a very expensive zone. And when high volatility is like that, especially I.5, and 5 is the highest, it's a 1 through 5 scale. The bottom line is that you're supposed to be a seller of options. Essentially, I was to go and sell a put on this position had I had the extra cash to cover the position, to cover the position, to be able to do what they call sell a put. And when you sell something, like any store, you keep the cash in your register. And like any business, it's kept in reserve until such time that the money is needed to go back to do R&D or buy more, restock the shelves. Here in the options world, when you sell a option, the cash goes into your account until such time that the option expires. And when it expires, then you keep the money. So what will you do when you're selling a put? When you're selling a put, as you see, the expiration here is 90 days. Well, when you're selling a put, you do 30 days because now you want time in your favor. You want that option to get worthless because you sold it. So had this been a sell, I would have sold it at 292, and then at the end of 30 days, as long as the price did not come down to the strike price that I sold it at, I get to keep the $292. What you have to understand, though, when you're selling a put, you also have to have the cash reserve to meet your obligation to buy it. So had we gone in and say, okay, we're going to use this lower price channel, and that lower price channel price is about 1720. So we actually need to go a little bit deeper. Here we go. There we go. 1672. Okay. So when you sell a put, you need $16.72 times 100. You have to have $1,672 in your reserve, in your capital. Now, when you sell the put, you're selling it down here and you're collecting upfront $292, and you get it. But the option is, and you're buying a 30-day option or less. You hear about the call weekly options. People selling weekly options. They sell an option, they collect the premium, the money up front, and then they wait for a week for the option to expire worthless. This is where the worthless statement of the methodology comes in. The option expires worthless because it's a sell. It's lost value, and you, the seller, keep the money. So it going worthless is important for you because you get to keep the money. And then this would have been, let's say you would have bought it here, and this is a April 29th, right there. It'd be April 29th. And let's say you sold it to expire tomorrow on the 21st, 3 weeks, and then it expires up here. That's what you want, because if you sell the option at this strike price, and the price comes down to that price at the end of the 30 days or the end of 23, this is a 3-week sell. You can do for 3 weeks, and then the 3 weeks, and it comes down and touches your strike price, then you have to buy it. So then you end up owning 100 shares at 1672. And the danger there is if the price continues going down into negative territory, and then you're going to sit there with a stock that's not going anywhere for you. But the point comes down is, this is what you hear this terminology say. Well, I hear options are risky because they expire worthless. They don't expire worthless unless you're doing a sell. But if you're buying an option and it goes up in value, such as you see here, and we're 42%, and if this option expired tomorrow on the 21st, which is the third Friday of the month, our option would be worth, the option, we bought the option at 205. I'm sorry, we bought the option at 205, and we're now at 292. So yeah, so you buy it at 20. So then when you sell the option, you get $205 in your pocket, and then you wait for the option to expire, and then you keep the $205 in your pocket. It is a very lucrative way and easier way of making money in options, but you gotta have the capital to back it up to do it. But that's what I'm getting on to about. I hear this thing: options are dangerous, it's risky trading. Well, tell me this: who bought Bitcoin at $50,000 and they're now looking at 30,000? Was that not risky? Yeah. Everything is risky. You just got to do is have a game plan, a trading plan to make it work. Okay. With that said, let's go ahead and do the numbers. Walgreens is waiting for a dipper low, but I want to get to this. So today we have 66. Sorry, we have 66.78 minus the 55.33 for the amount. Divide that by 55.33 as a percentage, and we're ahead at 20.7. And the S&P/Y came in at 10.2, and there's the proof. 10.61 for S&P/Y. So with that said, losers become winners. AIU at 42%, and Stochastic Strategy is at 20.7 for year to date. And with that, we thank you very much for stopping by.